Hello, welcome back to another video with Mind Money Masters. I'm your host, Cameron. Today we're going to be talking about and exploring the wide world of ETFs, or also known as exchange-traded funds. We're going to keep to the same beginner's guide theme here that we did with the stock market. This is number 2 video in our series, so if you haven't seen the stock market video, go back and check on my channel to see for the other stock market video. But today we're going to discuss what is an ETF, several types of ETFs, and various pros and cons associated with investing in ETFs. Of course, I will give you, like always, my final take at the end of the video, so please watch until the end. Thank you for your support, and please remember to subscribe to my channel and comment in the feed below on anything that you liked or if you didn't like. Plus, let me know if I can talk about something in particular regarding personal finance, investing, or making money online. Let's get started. Thank you again for watching. As I mentioned, today we're going to discuss some basics around investing in exchange-traded funds. Also, just as a point of disclosure, all of my opinions are solely mine and are not in any form of professional financial advice, as I am not a licensed financial advisor. Please work with your professional advisor before making any decisions. That being said, today we're going to talk about what an ETF is in investing, 3 different types of ETFs, some various pros and cons of investing in exchange-traded funds, and also whether or not ETFs might be right for you. I'll give you my final take at the end. An ETF, also known as an exchange-traded fund, I'll be using that kind of interchangeably during this video, but why do we call it an exchange-traded fund? Honestly, it's probably originally designed to be able to, because the actual investment was designed to trade the index or the exchange that it tracks. For example, if you'd like to purchase an ETF that mirrors the S&P 500, that could be the SPDR ETF. The ticker symbol for that is SPY. It contains all the companies, corporations that the S&P 500 index holds. Now, there are some major and minor differences between mutual funds and ETFs. Mutual funds may be a more common investment to you, that they are widely marketed and have been around for much longer. We will go into those differences, some of those differences here, but I have actually another video that I'm putting together that talks about more of a detailed comparison between ETFs and mutual funds. The biggest difference, I would say, is how they trade. So ETFs, exchange-traded funds, trade intraday, just like stocks. Gives you a little bit better way to manage your risk in the sense of if you need to get out of an investment or you need to get into a trade quickly, you're able to do that with ETFs versus mutual funds that trade at the end of the day. 3 main types of ETFs: stock, bond, and commodity ETFs. There are subsections of each, but these are kind of the main 3 categories. Obviously, you're going to have international stock, international bond. Commodity probably is the only one that doesn't have any additional subsets under it, because obviously commodity is just a good and service. A stock ETF, however, buys the company that are in the index. So all of the companies that are in the index that it tracks. Like we said earlier, the SPY ticker symbol will track the S&P 500. Now the PowerShares QQQ ticker symbol will track the NASDAQ 100, and the DIA will track the Dow Jones Industrial Average. A bond ETF will unsurprisingly track a bond index. So depending on what category of bond you are interested in, you can purchase actually the SPDR, that's a very common ETF company, SPDR's SPDR, long-term corporate bond ETF, which is the ticker symbol SPLB, which tracks the corporate bond index. So the Barclays US Corporate Bond Index is the index that ticker symbol will track. Now, there is also the iShares 3-year bond fund. That ticker symbol is SHY, which tracks the Barclays 1 to 3-year Treasury bond index. The last one I want to bring up here is commodity ETFs. This is an interesting sector. This can give your portfolio some exposure to the commodities market without actually trading physical futures or contracts on the commodity exchange. They will still track the various indexes, but so you can get exposure, for example, to silver by using the ETF SLV. It's called the iShares Silver Trust. Now, there's also, you can track gold through the SPDR Gold Trust, GLD. or even exposure to sugar, SGG, and oil, USO. So these are all tradable ETFs on the national exchange that track the index associated with their corresponding commodity. Usually a much easier way to get exposure to a commodities market versus opening an account with a commodities broker. So ETFs offer some diversification, but only in a very simplistic way. In the sense of diversification, meaning having a broader exposure to different kinds of industries, then yes, they do offer diversification, but they are still focused on tracking an index, which if market conditions require will drop, the ETF will also correspondingly drop in value. However, it may be less risky than purchasing individual stocks. For example, Charles Schwab is a financial organization, financial company that you can purchase on its own, or you can also buy it within the financial sector ETF. Likewise, Coca-Cola, ticker symbol KO, trades on the Dow Jones. Now, you can also buy that by itself, or you can buy the DIA that we mentioned a little bit earlier and get some exposure to Coca-Cola. There's not only potential trading costs associated, though, with buying and selling ETFs. Since they trade like stocks, there are expense ratios tied to ETFs that may lower your total return. If the expense ratio is 1%, then whatever return you receive on the ETF investment regarding appreciation will be decreased by the expense ratio. For example, in our scenario, if your average return was 8%, due to the 1% expense ratio, the actual return on your investment was 7%. However, most ETFs have much lower expense ratios than 1%, so it's not that big of an expense associated with your overall net return. However, there are some also correspondingly pros associated with ETFs with regards to tax benefits. So when you consider ETFs trading like stocks, you can reinvest the dividends and there aren't any capital gains tax unless the investment is sold. Now, for more information, obviously, on that, you want to contact your tax advisor and work with a professional associated with tax. So since I've mentioned multiple times that they trade like stocks, there are a couple other positives associated with ETFs, and that is being able to get in and out of an investment very quickly. That's kind of a liquidity piece and intraday trading. So since they trade daily, typically the liquidity or ease of sale to generate cash is high. Also, you can trade options against many of these ETFs, which can offer additional income, hedging, and leverage strategies. I will actually do a video here in the future, probably after mutual funds, regarding options. It's one of those investments that I trade pretty frequently. So we are now down to my final take. Are ETFs right for you? As you can imagine, I cannot answer that question for you. My goal is simply to provide you with the tools to answer for yourself. One book I would strongly recommend you to read regarding a good investment strategy is called The 3% Signal. It's by Jason Kelly, and it takes one ETF and one bond fund. That's it. You have two investments. It uses the IJR, which is a mid-cap index fund, and a taxable bond fund. Very simplistic strategy, but very effective. It marks the trend line of indexes and utilizes the assumption over time that the market will go up. And historically, it has shown this. It will have the link, and I will have the link actually in the description for you to purchase this on Amazon if you'd like. It's definitely worth the read. I read it and really enjoyed reading the strategy. So since this was one strategy that I mentioned, the 3% signal, you might want to figure out what you are trying to accomplish with any investment strategy. Are you looking for income, appreciation, or are you just highly speculative? There are many paths to the various goals that you would have in investing, and you could have all three at some point in time. Even at the same time, you could have all three. But I would strongly urge you that the focus on financial education is huge here. And get your trading education up. Find books on buying and selling and trading and day trading, swing trading, intraday trading. It can be truly, truly effective on any strategy. You don't want to go into a new strategy or something that you're unfamiliar with without any education on. That being said, don't wait forever to make a decision. Get your education and then take action. Now, the other thing I will mention and I have to bring up is that ETFs are still only one part of the stock market and only one piece of the asset puzzle. There are four classes of assets. Stocks, ETFs, bonds, and mutual funds are all in the paper asset category. There are three others: real estate, commodities, and personal business. If you've ever considered actually starting your own business or curious how I'm able to talk and write about investments and the things that I really love doing, my passions, please, I encourage you to check out the link in my description to Entre Institute. It's a program that basically they partner with you and offer you coaches, mentors, and teach you how to build three different types of business models. Investing in your own education is the best investment that you can make. Highly encourage you to check this out. Thank you so much for watching, and cheers to your success.